Good morning, good afternoon, or good evening from today. Welcome to Deloitte's Debrief webcast series in Asia Pacific. Our webcast today is from our transfer pricing series and is titled Preparing for Australia's New Country-by-Country Reporting Measures and Increased Transparency. My name is Graham Smith and I'm a Sydney-based partner and national leader of Deloitte Australia's transfer pricing practice. I have the pleasure of hosting today's webcast. And I have along with me today Mark Carlton, Dave Lidos and Mike Manser as presenters. Mark is a Sydney-based account director with over 15 years experience in transfer pricing with Deloitte Australia. David is a Melbourne-based tax partner with over 25 years experience in transfer pricing and has spent time with Deloitte in both Australia and the United Kingdom. And Michael is a Sydney-based account director with over 13 years experience, primarily focused in the financial services industry, and has spent time with Deloitte in both Australia and the United States. You may access our bios on the left side of the screen. Now, before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. Firstly, all users are on listen-only mode. If you have any content-related questions, you may submit at any time in the Q&A box at the bottom right of the screen, and we'll do our best to respond to your questions throughout the presentation. Secondly, for all PC users, you can maximise or minimise each of the boxes at your convenience throughout the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the downloads and the links box. On the other hand, mobile users, you can view the slides and answer the survey questions on your screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for more than 50 minutes. So moving on to the agenda, let me give you an overview of the topics that we will discuss today. Firstly, we'll spend most of today's session on the new Australian public country-by-country reporting measures. We understand that this is a topic of much interest to impacted groups, given the global reach of the measures. We'll spend some time giving a brief background to the measures and then step through the key aspects of the measures, including the scope of the measures, when they commence, the specific information to be reported, how they compare with other CBC reporting measures, and discuss the relevant penalties and exemptions that could apply to impacted taxpayers. We'll then provide some insights on key data readiness and other considerations for impacted groups. Towards the end of today's session, we'll also provide an update on some of the recent changes to Australia's OECD country-by-country reporting requirements. In particular, the Australian local file requirements and the country-by-country reporting exemptions framework. We will reserve some time at the end of the hour for a Q&A session to respond to some of the questions that we received from the audience. So now, to kick things off, I'm going to hand over to David. David, over to you.
Yeah, thanks, Graham. And we'll start the discussion here with a brief overview of the new public CBC reporting measures before getting into the detail. So on 10 December 2024, Treasury Law's Amendment Responsible Buy Now, Pay Later and Other Measures Bill 2024 received royal assent, which contains in Schedule 4 the much anticipated public CBC measures. And this followed a series of exposure drafts in 2023 and 2024, and the introduction of the bill to Parliament in June 2024. So the passage of these measures took some time, and we saw some changes over that time from the initial exposure draft legislation. Now, the measures affect certain multinational entities that operate in Australia, and we'll run through the specific scoping requirements shortly. By requiring the public release of specified tax and other information on a jurisdiction-by-jurisdiction basis, together with a statement on their approach to taxation. The measures apply to reporting periods starting on or after 1 July 2024, with reporting to follow within 12 months from the end of the reporting period. Jurisdiction-specific disclosures will be required for Australia and certain specified jurisdictions. And on 18 December last year, the government released via a determination the final list of these specified jurisdictions, of which there are 40. All other jurisdictions in which the group operates can be reported on an individual jurisdiction basis or on an aggregated basis. So there's an option to aggregate for those other jurisdictions, which we'll discuss in further detail later. Now, it's important to note, and just to avoid any confusion on this point, that the measures will operate separately and in addition to Australia's existing CBC reporting provisions. So that is Australia's existing implementation of the OECD's CBC reporting requirements, which have been in place for many years now. So this is a distinct and separate reporting requirement that's based on separate law. The measures will also operate separately to other public CBC reporting measures, such as the EU Public CBC Reporting Directive. And impacted groups should also be aware that there are some differences between the new Australian measures and both the OECD CBC reporting requirements and the EU directive, which we'll discuss later in the session. Lastly, the new rules include penalty provisions for failing to lodge or for late lodgement, which can be significant. So those are just some introductory framing comments to provide a general overview of the measures. And we'll discuss now what determines whether an entity falls within the scope of the rules. So the requirement to publish the selected tax information applies to an entity that's a CBC reporting parent, where broadly the parent or a trustee of a trust or the partner of a partnership is a constitutional corporation, which is essentially a trading or financial corporation formed in Australia or a foreign entity which carries on a business in Australia. And this is an important point, as this approach seeks to define the rules in a way that they may apply to foreign entities. And in addition, is an entity which is not an individual, is not controlled by another member of the same CBC reporting group, and has annual global income of Australian dollars 1 billion or more. The CBC reporting parent is only required to publish the information if it's a CBC reporting parent at any period, at any point during the preceding reporting period. And so we have to look to the status in the preceding year. It's a member of a CBC reporting group at any time during the current reporting period. And at any point during the reporting period, it or a member of the CBC reporting group is an Australian resident or foreign resident with an Australian permanent establishment. So there needs to be some taxable presence in Australia. And lastly, they were not an exempt entity or included in a class of exempt entities. And we'll discuss exemptions later in the session. It's also important to note that a CBC reporting parent that is an Australian resident and which has no foreign operations is still in scope if it otherwise meets the requirements. Now, there are some de minimis limitations to the scoping requirements, though these are quite low. And that is, a CBC reporting parents of CBC reporting groups with a small Australian presence are excluded from publishing. And this is based on having aggregated turnover of less than Australian $10 million of Australian sourced income. And on this point, it's important to note that the term Australian sourced is broadly defined for Australian tax purposes. And also that an entity's aggregated turnover is a very broad test and includes the entity's annual turnover together with the annual turnover of any entity, including any foreign resident entity that's connected with it or an affiliate of it at any time during the income year. So in considering this de minimis threshold, it's important for entities to exercise care in establishing their amount of Australian sourced income for all connected entities and affiliates, given that these concepts are quite broad. Next slide, please. Now, in terms of timing, as noted earlier, the measures apply to reporting periods commencing on or after 1 July 2024. So we're in the first live period now. And the entity publishes the information by giving the information to the Commissioner in the approved form within 12 months after the end of the reporting period to which it relates. So 30 June 2025 year ends will be the first period captured, with reporting to the Commissioner being due by 30 June 2026. It's the Commissioner that's then responsible for making the information available on an Australian government website And it's important to note here, though, that no guidance has been provided by the ATO as yet on how the information is required to be presented by the reporting entity to the ATO or how it will be presented publicly by the ATO. But the ATO's public guidance indicates that the reporting form and instructions are under development and will be made available during 2025. The ATO has also indicated that the first publication of the data is expected to be released in late 2026. Now, lastly, on timing considerations and for completeness, an entity's reporting period will be the period for which audited consolidated financial statements for the entity are prepared. And if the entity doesn't prepare such statements, the reporting period will be the period for which the entity would have prepared such statements had it been a listed entity. Now, let's discuss the information to be reported. And in terms of this information, there's both general information and jurisdictional information. So starting with the general information, this includes the CBC reporting parent's name, the names of each entity in the CBC reporting group, and a description of the CBC reporting group's approach to tax. In respect of the group's approach to tax, the legislation makes reference to GRI 207 or the GRI 207 tax standard as the relevant guidance. And we'll discuss the relevant guidance shortly. But GRI 207 with respect to the approach to tax indicates that the reporting organisation shall report information including whether the organisation has a tax strategy and if so, a link to this strategy if it's publicly available, details of the governance body or executives within the organisation that formally review and approve the tax strategy and the frequency of that review, details of the group's approach to regulatory compliance and how the approach to tax is linked to the business operations and the sustainable development strategies of the group. Next slide, please. Now, in terms of the specific information to be reported, one of the key features of the measures is that, as mentioned earlier, there's jurisdictional reporting for Australia and certain specified jurisdictions, and the option of aggregated reporting for all other jurisdictions in which the group operates. So just before we run through the data to be reported, we mentioned earlier the final determination that's been issued, which sets out the 40 specified jurisdictions, which must be reported on a jurisdiction by jurisdiction basis, rather than with the option to aggregate. And we've just listed on the slide the 40 specified countries that are set out in that determination. And as we can see, there's a mix of different countries here, including some of Australia's significant trading partners. And the explanatory statement to the determination indicates that these jurisdictions reflect current trends of multinationals that operate in Australia and their arrangements and dealings with offshore members of their group, with a range of factors being taken into account. Now, for groups that are also captured by the EU Public CBC Reporting Directive, it's important to note that there are some differences between the specified countries list as shown on the slide and the EU list of non-cooperative jurisdictions for tax purposes. So groups captured by both measures may have differences in terms of jurisdictional reporting and aggregated reporting between the two measures. And so it's important to be across these countries if you're a group that will be looking to take up the option to aggregate. Next slide, please. Now, stepping through the jurisdictional information to be reported, which we've set out there on the slide. Just to step through each item. So for Australia and the specified jurisdictions, there's the name of the jurisdiction, a description of the main business activity in the jurisdiction, the number of employees on an FTE basis at the end of the reporting period, revenue from unrelated parties, revenue from related parties that are not tax resident in the jurisdiction. And this is an item where we see a difference with OECD CBC reporting, which reports revenue from all other constituent entities, including in the same jurisdiction. And we'll go into some further detail on some of the differences with other CBC reporting measures in a moment. There's also profit or loss before tax, book value of tangible assets at the end of the period, income tax paid on a cash basis, income tax accrued, the reasons for differences between income tax accrued and the amount of tax that would be due if the prevailing tax rate was applied to profit before tax, so a further narrative requirement here. And lastly, the currency used in presenting the information. For all other jurisdictions, the names of the jurisdiction are not required. Reasons for differences in the tax accrued and the tax rates not required. All other items are required with the option to aggregate. Lastly, the explanatory memorandum to the rules also notes that CBC reporting groups may also provide further context to their reports in separate disclosures, which could include a broader tax transparency report on their websites. Now, again, in terms of the specific information to be reported, where relevant in interpreting the requirements, the disclosure should be made so as to best achieve consistency with GRI 207. And the rules indicate that regard should also be given to the OECD transfer pricing guidelines and the OECD CBC reporting guidance. But the explanatory memorandum to the rules makes clear that GRI 207 is the primary source of guidance, and it's for this reason that the data requirements are quite consistent with GRI 207. Now, whilst at face value, the data points may seem consistent or quite similar to OECD CBC reporting requirements, and there may be some overlap. There are some important differences to note in terms of the data requirements. And there are also some differences in the data source requirements and the relevant guidance material for interpreting the data requirements, which we'll run through. But before we discuss these points, I'll hand back to Graham.
Thanks, David. Now, before we jump into the conversation about those specifics of the Australian data points vis-a-vis those in other public country-by-country reporting regimes, an opportune time now for our first polling question. And we're keen to gauge the audience's current approach to tax transparency reporting. And the question is, do you currently publish a group tax transparency report to the public? And the options that are available on the screen include, yes, we already include CBC report data. Yes, but no CBC report data is included at this stage. Or the third option is no. So whilst we wait for the results of this poll, David, a quick question for you. You spoke a little bit about the approach to tax. What does that practically mean for a taxpayer?
Yeah, look, thanks for the question, Graham. And there's limited information in the legislation itself or the EM on this point, but GRI 207, as mentioned, provides guidance on this topic, particularly disclosure 2071. So as mentioned earlier, this includes whether the organisation has a tax strategy and the key elements of that strategy, how it's applied across the organisation. This might include details of the governance bodies or executives in the organisation that are responsible for reviewing and approving that tax strategy. It may also include comments on how the group seeks to address its tax compliance obligations in the jurisdictions within which it operates, and how the group's approach to tax is linked to the wider business and also the group's sustainable development strategies. So look, in general terms, this is a description of the group's overarching tax principles, how it balances tax compliance with its business activities. It may include comments on the group's approach and attitude towards tax planning, the approach to engaging with tax authorities, and how the group's tax affairs are managed and governed within the organisation. So look, of course, this will vary across organisations, but we would expect that many groups, particularly public groups, already have some form of tax transparency reporting that may provide a basis for this information.
Thanks, David. And just a quick recap of these polling results. And it's, look, I mean, obviously no surprise to many that are participating on this call. There is quite a bit of work. Interestingly, just over a third of our audience is preparing a tax transparency report, with almost 2/3 indeed not. So it would seem as if there is a fair bit of work, time and resources required for many of our participants today in getting ready for this new tax transparency regime. So very interesting results. Michael, just as David indicated, there are some differences in the data source requirements and also the relevant guidance material for interpreting those data requirements. So with this in mind, I'll hand over to you. It'd be helpful if you could take us through some of these important points, along with some of the comments on possible exemptions available under the new measures and potential penalties for non-compliance.
Thanks, Graham. So if we move on to the next slide here, and what we've got shown is a table essentially comparing the various CBC report measures. So you can see on the left-hand side, the Australian Public CBC report and all the items that David talked about before. And to the right, we've got the OECD CBCR and the GRI 207 standards. And as Dave mentioned, they're the two sets of guidance materials that are referenced in the law. And I think on the right-hand side, just for completeness, we've also listed out the EU Public CBC Directive, even though it's not technically referenced or relevant for Australian law. So as highlighted in green, there is in fact a large degree of overlap between the Australian Public CBCR and the GRI 207 standards, that there are some differences in the reporting requirements between the Australian report and both the existing OECD report and the GRI 207 standards. So I think most notably, and as groups start to prepare the EU Public CBC report for the first time this year, there are a few particular things that are quite different, which multinational groups should be aware of and which Dave touched on a little bit earlier. So in terms of additional fields, and there are a couple to call out, as you can see in the first row, and as Dave talked about quite a bit earlier, there is the requirement for entities to provide the group's approach to tax. So that's something that's going to be quite different and quite an uplift in terms of an exercise that needs to be done. And then towards the bottom, as you can see, entities are also required to describe any differences between the effective tax rate and the statutory tax rate for both Australia and for all specified jurisdictions. I guess second thing to note, in terms of nuances between the Australian report compared to the OECD report and the EU report, there are a few things to call out which we've highlighted in grey. So I think firstly, in terms of business activities, entities are in fact required to provide a description of main business activities, which is a little bit different to what's required for the OECD CBC report, where entities are simply required to just categorize their operations in, I think, 13 or 14 different categories. Secondly, the number of employees, as Dave mentions, is to be reported on a full-time equivalent basis at the end of the reporting period. So that doesn't provide any sort of flexibility compared to what you might have seen previously with the OECD CBC report. And then lastly, revenue from related parties, as Dave mentioned earlier, should only include amounts from those that are not tax residents of the jurisdiction. So again, that's a difference between the Australian report and the OECD report. So on to the next slide. And what we've got here on the screen are some points on both data sources and corrections. So I think firstly on data sources, one important thing to note for the Australian report is that the amounts reported by the entity must be based on amounts shown in the audited consolidated financial statements. And that's quite different from the OECD CBC reporting guidance materials, which are still referred to as relevant guidance materials in the law. But as a lot of people on this call would know, there are various options for the source of data reported. So in instances where the CBC reporting parent has not prepared audited consolidated financial statements for the given reporting period, the information published must be based on amounts that would be shown in such statements had the entity been a listed company, as defined in another section of the Australian tax legislation, and been required to prepare them. Overall, groups should be aware of the different data requirements across the various CBC reporting obligations worldwide, which may in some instances require consideration of different data sources. And Mark will talk about this in more detail very shortly. On to corrections, and it's important to note that the law states that corrections of material errors must be made within 28 days of the entity becoming aware of the error in the prescribed form that will at a later date be released by the ATO. One other thing to note is that there is also a provision for entities to correct non-material errors. While the definitions of material and non-material are not defined, the explanatory memorandum to the legislation states that materiality is a matter of professional judgment, and that it is expected that CBC reporting parents will have regard to their relevant accounting standard in determining whether an item or an aggregate of items is material and would be required to be recognised and corrected. So Graham, I'll hand it back to you at this point for our next polling question.
Michael, thank you. And as you noted, that brings us to our second polling question for the day. And the question is, indicatively, at this stage, do you think you will likely use the ability to aggregate data for those unspecified countries in the Australian Public Country-by-Country Report? The options available to us are yes, or we're still considering this, however, open to the option, or the third option is no. And so while we wait for the results of this poll, Michael, a quick question has just come up for you. Where an entity, or if an entity, I should say, is preparing an OECD country-by-country report and has to prepare an EU public country-by-country report, now we've thrown Australian public country-by-country reporting into the mix, what should be done if there are differences in the data sources?
Very good question. So look, at the end of the day, entities do have to make sure that they use the data that meets the requirements of each particular reporting requirement. I think that's be all and end all. So it could be that an entity may still be able to use the same data source, but it might be that they have to use other sources. That just might be the case. And it might also be the case that an entity may have to use a different data source from what's been done for, I suppose, nearly 10 years with the OECD CBC report. But yeah, as I mentioned earlier, amounts have to be based for the purposes of the Australian CBC report based on the audited consolidated financial statements. And that, incidentally, is something that a lot of groups at this moment having to think about with respect to Pillar 2 and the transitional safe harbour.
Thanks, Michael. And just a recap of these results, I certainly think it would be no surprise to anybody to know that the vast majority of this audience is certainly considering or will be using that option to aggregate those countries where we are not required to separately disclose. So that's a very interesting result. And so, Michael, just coming back to you once more, would you mind sharing with the audience some more of the detail about the potential penalties and the possible exemptions that could apply to taxpayers under the new public country-by-country reporting regime?
I certainly can. So what we've got on the screen now is a little bit of an overview about penalties. And so I think to start off, I suppose the penalty regime clearly indicates that Australian resident entities will be subject to penalties under Section 8E of the Taxation Administration Act if they committed an offence under Section 8C by either refusing or failing to comply with their obligation to publish the information required. That being said, there is currently no detail on how the penalty regime will apply to CBC reporting parents that are not Australian residents, such as foreign residents with Australian operations. Separately, an administered penalty will apply in the case of late or non-lodgement or for a failure to correct material error. And towards the end of the slide, in terms of figures and what this all means, so an entity will be penalised 500 penalty units for each period of 28 days or part of a period of 28 days, starting on the day when the information is required to be published and ending when the entity provides the information to the ATO, up to a maximum of 2,500 penalty units. And as I think a lot of people know, the penalty unit value increased recently from 313 to 330 Australian dollars a couple of months ago now, which means that the maximum penalty for non-lodgement or late lodgement of the Australian Public CBCR report would be $825,000. On to the next slide, and on the topic of exemptions. So the bill, or the law as it is now, provides the Commissioner with the power to provide exemptions to 3 different categories. And that can be either a class of entities, specific entities, or specific entities in respect of information of a particular kind. The explanatory memorandum to the legislation makes it clear that such exemptions will be granted only in limited circumstances and states that it will expect the ATO to provide more comprehensive guidance in relation to how the exemption powers will be applied. An exemption for a specific entity or for particular information of a specific entity will only apply for a single reporting period, and that will require an annual request for such an exemption. The other thing to note is that the explanatory memorandum to the legislation states that with respect to such exemptions, it would be appropriate for the ATO to consider whether disclosure would either affect national security, breach Australian law, disregarding the requirements imposed by the public CBCR, or breach the laws of another jurisdiction, or result in substantial ramifications for an entity by an objective standard by revealing commercially sensitive information. The bill also provides the Commissioner with the power to exempt government-related entities from these reporting obligations. The ATO is planning on the release of a practice statement by February 2025, according to the current website, which will outline the Commissioner's approach to public CBC reporting exemptions. The guidance is expected to include details on the process for submitting applications, information that should be provided with these applications, and considerations relevant to the exercise of the Commissioner's discretion. But apart from the guidance on these exemptions, I suppose we're also expecting further guidance as a distinct likelihood to be needed from the ATO on the design of the filing, the lodgement mechanics, and associated processes, as well as further guidance on the specific information to be reported. Graham, I'll hand it back to you.
Yeah, brilliant. Thank you, Michael. And so just moving on to our next polling question, which is how much additional work is required to get your business ready for Australian public country-by-country reporting? And the options available are very little, we have it covered, some additional work required, or thirdly, a substantial amount, we would require additional support and resources. And whilst, Michael, we allow the audience to respond to the question, just reflecting on the ATO's current approach for the existing country-by-country reporting regime, which Dave is going to provide an update on towards the end of this presentation. In your view, what do you think the likelihood of an entity getting an exemption from these measures would be?
Yeah, good question. I suppose we'll have to see what is said in the exemption guidance when that comes out. But looking at the legislation itself, it makes it pretty clear that exemptions will only be provided in limited circumstances. So I suppose the other thing to add is we've also seen a shift in existing OECD CBC report exemptions and a tightening of those exemption availabilities, which might potentially provide an indication of the limited scope of exemptions available for these new measures. But we'll be touching on that a little bit more at the end of this session.
Thanks, Michael. And again, just to come back and recap on these polling results, Mark, I'm going to bring you in here in a moment, but fascinating, and again, similar to some of the results of these other polling questions, a vast majority of our audience, over 90%, are suggesting that at the very least, some additional work is required to get their Australian country-by-country report, public country-by-country report, up to scratch. With over 33, almost a third of our audience requiring a substantial amount of additional support and resources to get their Australian public country-by-country reporting in place. And so, Mark, just as I said, bringing you in here, it would be great to hear from you about some of those key data readiness and process considerations that taxpayers need to think about when implementing Australian public country-by-country reporting.
Yeah, sure, Graham. And I think building off some of the background already explained by David and Michael around the requirements and who it might affect, it is a good time to sort of focus on those next steps and what it could look like. But just before we do, it would be worth recognising that the CBC report is a great case study of how we can break down a near decade-old process through CBC reporting and start to overlay multiple regimes, multiple requirements, such as public CBCR in Australia. And this is in order to help build a more robust and efficient process across more than just one regime. And the CBC report has also been quite topical over the past 12 to 18 months, given its relevance to Pillar 2 and the transitional safe harbour work streams, that many multinationals, particularly those on this call, would have already been working through. So to break down the country by country report process, let's think about the different themes that would be involved. And if we start with the overlapping points, this recognizes that whilst we are talking about the country by country report, there are a number of different regimes, such as transitional safe harbor, which I mentioned, and historical C by C compliance. But there's also the different standards that we're dealing with, such as the OECD, the GRI standards, and the EU directive, just to name a couple. So the first steps are trying to overlay all of the different final deliverables that use the country by country report as a starting point, and then map out what standards or requirements are needed thereafter. So what is worth being mindful of is that actually, directionally, we've actually seen a convergence and a greater overlap over the different iterations of Australian public C/CR. So whilst earlier drafts of the legislation might have gone beyond the historical C/C report requirements and they added in new disclosure types, the iterations thereafter have actually directionally paired it back to a lot of, align a lot with what we're seeing required across other regimes. So at the end of the day, you would argue duplication in this case is actually a good thing. So once we understand what are some of those gaps or what is needed, we would then move into the data source. And this is where an older process like C/C reporting, which as I mentioned is nearly a decade old, we may need to go back to the basics and understand how has it been done in the past. And ultimately, as a broad generalization, we can say that there has been a convergence of the data requirements across all these regimes, where we need to be able to reconcile to consolidated accounts as a broad theme. And this may affect companies who have relied on the slightly more lenient approaches that are available under historical C/C reporting regimes. So once we understand the source and we start moving into how do we go about using this data and think about the definitions, Michael and David already outlined a couple areas where there will remain differences or nuances in some definitions, reflecting, for example, those differences between the GRI 207 standard and the EU directive. However, as a general observation, historical OECD approach to C/C should remain a cornerstone. And there have been steps over the past 12 months where different bodies such as the OECD have sought to converge and confirm aspects of these definitions. So for example, companies working through the Pillar 2 and transitional safe harbor requirements would have benefit from the OECD providing information on the topic of dealing with dividends, for example, in relation to the revenue and PBT fields. And this directionally has helped align the approach taken by a lot of companies. In other words, another way to look at it is a lot of the definitions have been converging, and this will reduce other parts of the process that need to be managed, such as version control, internal controls around addressing nuances, and building consistency across the public disclosures made by the company. So finally, we move into that last mile aspect of the process. And this is where experiences from 2016 and the implementation of C/C reporting will actually provide a lot of insights. And what I mean by this is that as an industry, we are comfortable and familiar with the use of XML schemas and software to manage the conversion processes. And a lot of companies during the original C/C reporting and implementation period, they also built a lot of robust processes for managing large multi-jurisdictional projects and how certain steps in the process may require some local nuance or process for different requirements. And this is where learnings can be adapted for the additional regimes such as public C/CR, particularly given this is helping build a robust control framework to manage the public disclosure of company data. So now that we've touched on the themes, if we were to visualize some of the aspects required for C/C reporting on the next slide, we can kind of get a starting point for what might be an ideal process or future design. And the next slide will just come up. But some key points to recognize with this is in relation to the data source. So given we are essentially moving to a consolidated data and reconciliation requirement, it may lend itself to having one centralized and single source being an ideal or aspirational requirement in the process. This also means that having a robust process regarding the dimensions of the data and what is extracted so that it can be replicated year on year or periodically in a consistent manner is going to be key. So that's not to say that practically there will not be companies that will have to manage multiple sources of data. I mean, by way of example, recent M&A activity or legacy ERP systems may be factors that influence this for some companies. And a lot of companies will already be sourcing non-financial data systems for things like headcount. But the key takeaway is that it makes sense to review these processes and try to reduce where possible the input and processes surrounding the data extraction where possible. The second point is around the centralization of the process, particularly around the data cleansing, the data transformation, and the calculation steps involved. Now, these steps could be centralized across a number of the different regimes, from Pillar 2 transitional safe harbors, C/C compliance, public C/CR, and tax transparency reporting as well. And it's achievable given the fact that we have overlapping data sources, overlapping data definitions, and in a lot of cases, we may see relevant stakeholders are also the same. So it's clear that this is the ideal, given it reduces the potential duplication of work required, but importantly, this would help tax functions manage the consistency of the data being used, the public disclosures that are being made, and a centrally designed rule set for these work streams can be maintained and potentially automated going forward. Lastly, one last point around a potential decision-making in the process, the visualization illustrates that there may be a decision process for determining which of these steps are optimally served via either a centralized or a decentralized process, and whether there may be a local team involved. For most regimes, there will be local specificities that need to be addressed. And in a practical sense, some of these may be forced by things such as the software requirements or the administrative aspect of the lodgement process. But more generally for Australian public C/C, some specificity and steps that will need to be considered by tax teams regarding this process include the classification of the specified countries and the management year on year of this list, addressing the aggregation step that's available under the Australian rules, the additional qualitative disclosures like the tax effect differences in the business descriptions, but also to the lodgement process, which has been canvassed as a website to facilitate this step, but there may be steps like the registration and the like. So to wrap up on these points, I stress this is a diagram for illustration purposes of what is aspirational, what might be ideal. But it does seek to use data and process to reduce the duplication involved and to manage a consistent narrative for the global group. There are, of course, going to be a lot of deviations to this ideal process, and this is going to be necessary on an individual company basis for some of the factors or examples I've already mentioned. But overlaying this will also be the interaction of the more holistic strategy of the tax function when it comes to tax transparency. And as with this, I wanted to touch on two other points on the next slide, because whilst these new rules are new, and we will be seeing a growing public database of C/C report data in Australia and the world. If we look at the larger Australian listed companies on the slide with the statistics, there is generally a majority who prepare and publish some sort of tax transparency document. However, there is only a very small proportion that will actually disclose C/C data. So it was interesting seeing those results in the polling question earlier. Now, what GRI have actually said is that of the top 1,000 companies globally, about a quarter of these say they will report to the GRI 207 tax standard, which is essentially C/C reporting alongside tax strategy and governance. But let's also not forget that the GRI 207 standard is the backbone of Australian public C/C as well. So companies have indicated they've got the intentions, although have historically been lagging behind on the C/C front relative to other forms of tax transparency. So the 2 points that perhaps leave you with on this is around timing in particular, given that for junior year-end companies, the very first deadline for Australian public CYCR is 30 June 2026. And so this would be a decision-making process about would public CYC data or would CYC data make its way into existing tax transparency documentation and get ahead of these deadlines, noting too there are other deadlines around the world that have either passed or coming up. And then the second point is around what additional narrative and what is my strategy around that narrative will I want to add to either a website or existing tax transparency documentation to facilitate the discussion and public discourse around this data. So to wrap it up and just to go to the final slide on this segment, certainly there are aspects, so just on the next slide, so certainly there are aspects of considering what are some of the gateway thresholds and what is the criteria that needs to be met in order to apply these rules. However, this is also an opportunity about understanding how we use the CYC report to build a new and robust yet efficient process to handle multiple regimes, given it is ultimately a decade-old process. So with that, Graham, I'll just pass to you. So I think we're moving to a polling question.
Yeah, thanks, Mark. Certainly sounds like taxpayers have got their work cut out for them. It was really helpful information. Thank you. As Mark said, an opportune time now to understand from the audience where you are at with your country-by-country reporting processes. So with that, our next polling question, and the question is, have you recently changed, updated, or refreshed your CBC report processes? And the options available include yes, though primarily due to the Pillar 2 requirements, or yes, primarily due to the public country-by-country reporting requirements. Thirdly, yes, primarily due to changes in the business and the need for a refresh more generally. Or the fourth option, yes, for all of the above reasons. And then finally, no, not at this stage. We have not refreshed or updated our public country-by-country reporting processes. And so, Mark, whilst we wait for the audience to provide some of their responses to this polling question, a question has come through in the QA panel, which I thought may be of relevance to you. Where will this public country-by-country reporting data be published by the ATO? And in what format is it likely to be published?
Yeah, I think that's a really interesting question. I mean, given that the guidance from the ATO is still forthcoming, I think what we can do is lean on past experiences. So in Australia, we have had a historical approach adopted called the Report of Entity Tax Information. And this is a website that contains just very, very high level information regarding different entities. The broad thresholds of the companies that need to share this information is typically over 100 million in revenue. But using that as perhaps a bit of a guide as to what we could expect, this is essentially a table of data that can be exported in Excel with all of the different company names going down a list, with each column being the relevant data or data field. So I think looking at the CYC report and what's required, I think it's only natural to expect something similar, albeit how this would work with multiple jurisdiction lines per entity. That would make it a little bit trickier, I would imagine. And it may also either directly or indirectly show elements such as exemptions as well, whether via missing data for certain years or an explicit mention of this. So these are obviously speculation as the guidance is coming out, but it's probably something we can lean on to sort of have a bit of a guess.
Yeah, thanks, Mark. And you've probably taken a glimpse at the poll results and your eyes have lit up, given that almost 48% of, or almost half of our audience have not updated their country-by-country reporting processes. A handful have done so by virtue of Pillar 2, which is no surprise. But yeah, very interesting results there. So I think we might move on. Mike, I'm just going to throw back to you for a moment. There have been some other developments locally in Australia in regards to our existing country-by-country reporting regime. Mike, can you spend a few moments talking through what some of these changes entail?
Of course. So on to the next slide, and just to give you a bit of an update. So on the 23rd of December 2024, so a couple of days before Christmas, the ATO released both the detailed design for the new local file master file, or as it's abbreviated, LCMSF schema, and the local file instructions for the 2025 income year for reporting periods beginning on or after 1 January 2024. The new submission is essentially the ATO's implementation of Australia's existing CBC reporting regime. And in terms of the changes, I suppose the new schema integrates the short form local file directly into the message structure table, which was previously only used to record details on international related party dealings in Part A and Part B of the local file. And according to the ATO, the purpose for this integration was to try and address what they identified as some of the inconsistencies and gaps in the current short form local file reporting regime, and reflects the ATO's focus on obtaining more detailed and structured information to better detect high-risk international tax arrangements. The changes are particularly notable in that the short form local file instructions now explicitly indicate that the LCMSF submission is not just related to transfer pricing anymore, but also other Australian tax risks more broadly, which include but are not limited to things like Part 4A, which is the Australian anti-avoidance rules, withholding tax, Division 832 on hybrid mismatches, Division 855 on capital gains and losses, Division 974, which are the debt and equity rules, and deductibility. So I suppose for taxpayers that are within the existing CBC reporting regime here in Australia, it is possible that they may need to undertake a significant amount of work, firstly to assess whether there are any restructures, and to the extent there are any, doing a lot of work to determine the appropriate disclosures that should be made for each step of the restructure, which would include the financial and tax impact of each step, a description of each step, and I suppose also to add in terms of the additional scope of the short form local file, these additional requirements could require taxpayers to collect and analyse on an annual basis a significant amount of information related to both transfer pricing and income tax, including potentially sourcing certain material from overseas affiliates. So in this respect, taxpayers may consider it necessary to engage with advisors at an earlier time than usual this year to input or assist on how to approach this information gathering and disclosure requirements. So Graham, I'll hand it back to you.
Great. Thank you very much, Michael. And let's move forward to our final polling question. And the question relates to the new short form local file for Australian country-by-country reporting, I should say. Have you considered the new short form local file changes that will be applying for the first time this year? And our options are yes, we have made some progress. Yes, however, only preliminary research at this stage. Or the third option is no at this stage. So Michael, whilst we wait for the results of our final poll to come through, Michael, you talked about the new disclosures and you mentioned the message structure table is now in a different format for short form local file, different from that to prior periods. Practically, how does it differ from the existing short form local file approach?
Yeah, so, I think firstly, key thing to note is that the information is now required to be provided in a very specific format, whereas I think previously the short form local file, a Word or PDF document, which provided a bit more flexibility. But essentially the new instructions make the reporting requirements related to business lines to be more pronounced. As I mentioned before, there's going to be a lot of work required on restructures, a lot more than needed to be done last year and previous years. And then in relation to cross-border reporting lines, potentially similar amount of work, but it may sort of depend company to company.
Yeah, thank you, Michael. And again, I think if we reflect on On the audience participation today and where many of our audience is geographically located, no surprise that almost 90, in fact over 98% of the audience have only done either some preliminary research at this stage and have not made any progress at all in regards to the Australian short form local file. So again, a substantial amount of work required for many taxpayers, and important that they get ahead of that as soon as possible. And so, David, just finally, coming back to you, there are some other changes that the ATO have implemented regarding the existing exemption process in regards to the OECD country-by-country reporting regime. So, David, I might turn it over to you to discuss some of those changes.
Yeah, thanks, Graham. Sure. And so just to give an overview of these changes further to what Michael just ran us through. So in late November last year, the ATO released changes to its existing country-by-country reporting exemptions framework. And so previously available exemptions for the local file, master file, and CBC report have been limited, with exemptions now only available for the CBC report and master file in limited circumstances. Local file exemptions are all but gone, with all in-scope taxpayers now required to file at a minimum a short form local file, which, as we just heard from Michael, will be a much broader, or potentially a much broader form for reporting periods starting from 1 Jan 2024. Now, the revised exemption guidance applies to all exemption requests received by the ATO on or after 1 January 2025. And we've listed on the slide the 3 exemption categories that remain. And these are, firstly, for the CBC report, where there are no overseas operations of an Australian group. And so this is a difference from the public CBC reporting measures. Also, for the CBC report, where the annual global income of the foreign parent is more than 1 billion Australian dollars, or equal to 1 billion Australian dollars or more, but falls below the CBC reporting currency threshold in the jurisdiction of the foreign CBC reporting parent. And so this was one of the existing or previous exemptions available, so this has been retained. And lastly, for the CBC report and master file, exemptions are available where an entity was a CBC reporting entity in the preceding year due to membership of a group, but leaves the group during the reporting year due to a demerger or a sale, and will not be a CBC reporting entity under the new structure. So we can see here that the exemptions framework for existing CBC reporting requirements has been narrowed down to quite limited circumstances. And so for groups within scope of the Australian CBC rules, particularly those that have relied on exemptions in the past, it's important to be aware of these changes, especially those that haven't filed local files on the basis of having no international related party dealings. So these entities will need to start considering the short form local file requirements at least. And again, as we just heard from Michael, these short form requirements have the potential to be quite a bit more involved going forward. So I think, Graham, that brings us to the end of the formal content, and I'll hand back to you for the remaining part of the session.
Yeah, brilliant. Thank you very much, David. And to you, Mark and Michael, thank you very much. As you indicated, this does bring us to the end of today's discussion. We've got a little bit of time to respond to some questions from the audience. And Michael, I might just quickly throw to you for this first question. What happens if my Australian business is sold partway through the fiscal year?
Yeah, I suppose with any of these questions, at the end of the day, you have to look at specific rules as set out in the law and whether you meet the scoping requirements. So there could be any number of practical issues that could arise. And we've seen this over the years with the existing OECD CBC reporting regime and the practical complexities that have arisen over time and have been responded to by the ATO. So, hopefully we'll see similar guidance provided by the ATO for these new public CBC reporting measures.
Great, thank you, Michael. And Mark, I'm going to throw to you. There have been a couple of questions here, and I might try and blend the two of them, if I may. One talks about where we have to report. So if we have to report under the EU directive, can we use the same report or provide a link to that report? And then similarly, another question relates to, will an ultimate parent entity be able to file a public country-by-country report in its own jurisdictional country as a result of any intergovernmental sharing agreement of the information? And the example was cited between, say, for example, Canada and Australia. Or will they likely be required to register with the ATO to separately file the Australian public country-by-country reporting information?
Yeah, that's a good multi-part question, that one. So I would go back to the language from David earlier when he was saying, look at the public CYC requirements as a distinctly separate regime. And so when we come to the point about EU directive CYC report, which is predominantly European countries, as the name suggests, when we've got public CYC reporting in Australia, broadly following the GRI standard, and then when we've got existing CYC reporting compliance, I certainly would be taking that mindset across those. So each one is distinctly separate, albeit from a process perspective, you might be wanting to bring it back to data, having a somewhat centralized and common data source, some common and similar sort of approaches to using that data. And then at the very last moment, maybe there's some local specificities or changes that are needed so that you are producing a different report for each of those. That would then lead itself to separately distinct lodgement or last mile processes as well. So I wouldn't be looking at the existing CBC report and the exchange mechanism that we've traditionally been able to rely on. That's not going to be relevant here in the public CBC sphere. So certainly the takeaway is to look at these as all distinctly separate, try to centralize some of the upstream or upstream sort of elements as best as possible, but then manage each work stream as separate points accordingly.
Great. Thank you very much, Mark. Unfortunately, that is all the time we have today. Mark, David, Michael, I did want to express my sincere thank you to each of you for the presentation. It's been very helpful. But most importantly, a special thank you to all of you who have been able to join us today. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you did join us late, please note the presentation will be archived for future viewing. And if you feel that others would benefit from this webcast, please share the webcast via the Share This icon or have them visit the Dbriefs website. And we'll endeavour to respond to all of the questions submitted during the webcast over the next couple of weeks. Also, if you think of any other questions or comments later, please feel free to reach out to either myself or any of our speakers. We'd be more than happy to talk to you. So please tune in to our next webcast titled New Legislative Bill on Company Redomiciliation Regime on the 10th of February 2025 to be presented by Ken Yan and Kenneth Lau from our Deloitte Hong Kong team. And lastly, from all of us at Deloitte, we thank you for your participation in Deloitte's Asia Pacific Tax Webcast today. Enjoy the rest of your day. Goodbye.